A very warm welcome to CNBC Africa's special broadcast of Nigeria's Monetary Policy Committee meeting. I am Wole Famerewa. As Nigeria's Monetary Policy Committee concludes its fourth monetary policy meeting led by the Governor of the Central Bank of Nigeria, Godwin Emefiele, 9 of the 11 members of the committee voted to leave the benchmark interest rate unchanged at 13.5% in May. We'll find out how they decide shortly. Now, since the last meeting, inflation declined with June figures coming in at 11.22%. The Apex Bank rolled out a couple of directives to the banking sector aimed at improving lending to the real sector. And just before that, the CBN governor disclosed his 5-year policy direction for his second term. But meanwhile, Nigeria's President Muhammadu Buhari presented the list of ministers for his cabinet to the 9th National Assembly earlier today. And looking at the global front, the U.S. Fed Chair Jerome Powell hinted at a possible rate cut, while oil prices have remained above $60 a barrel as producer group OPEC agreed to a continued supply cut even as global trade tensions persist. Meanwhile, in the UK has continued its march towards Brexit as Boris Johnson emerges as the leader of the Conservative Party with just 100 days to the Brexit deadline. But just before we go into our analysis in the studio, Peter Mushangwe, banking analyst at Moody's, joins us on the line from London to share his thoughts on the recent directives of the central bank to the banking sector. Peter, thank you so much for speaking to us. We'll obviously get into the MPC decision, but I just wanted you to reflect on some of the moves we've seen initiated by the central bank to ensure that we get lower rates in Nigeria. It obviously has worked. We're seeing interest rates at lows that we haven't seen in a while, and they have clearly stayed there over the last few weeks. But what's your perspective on the impact of the central bank's push for lower rates right now?
Good afternoon, Wole, and your viewers. Yes, obviously you're right that there have been a number of directives. I think just to give perspective, where the directive on the 4th of July, where the central bank imposed a minimum loan-to-deposit ratio of 6% for the banks, and a few days later with another where it kept the remunerable daily placements by banks at 2 billion from 7.5 previously. So overall for us, these directives are credit negative for Nigerian banks because they may force some of the banks to take out potentially riskier loans in order to meet the directive. But I should also put things in perspective to say that although we think that they are credit negative, the amount of new loans that are likely to be created because of these directives is small. The current loan-to-deposit ratio is about 58–59%. So for an average Nigerian bank to satisfy the directive, it would not need to grow its loan book excessively. For the banks we rate, the Moody's rated banks, we estimate that the loans will grow by just about 1.5%. The banks will grow their loan by about just 1.5% of total outstanding loans. So all in all, it's very negative, but it's not going to cause a lot of harm in the short term.
All right, so not a lot of harm in the short term, but looking at the growth of the sector as a whole, if banks now have to comply with that, pretty much every time they take deposits, they must have a plan. Of course, I'm speaking about banks that are already somewhere around the threshold of 60%. Anytime they take up deposits now, they have to have a plan to immediately lend a chunk of that out. Do you get a sense that this could begin a chain of, if you like, subprime loans in Nigeria? Because many will suggest that the environment simply is not the best to begin to create new loans.
Yeah, I agree that the environment is still pretty vulnerable. I mean, when we look at the banks, the NPL ratios are still elevated. We expect the NPL ratios to come down to about 7.8%. Maybe some banks will write off some of their bad loans. Some banks will reclassify some of the exposures that they would have resolved, for example, 9 Mobile. And the new NPL formation in the system is pretty limited. But, the banks do not have that significant capacity. So maybe as they resolve some of the NPLs, they can create a bit of a buffer for them to lend. So I agree with you that the operating environment for Nigerian banks is still very challenging. It's still very challenging, and the banks still face risks in terms of sectoral and single name exposures. The oil and gas, cyclical oil and gas sector still contributes a fairly huge amount to banks' loan books at about a third. And foreign currency loans in the system still remain fairly high at about 40% of total loans. And more importantly, the leverage of Nigerian corporates has been deteriorating. I mean, when you look at the debt to EBITDA ratios for listed companies, or the debt to equity ratios for listed companies, it has deteriorated. So the operating environment is still difficult for banks.
All right, Peter, thank you so much for sharing your perspective. I think that really sets the tone for further conversations today. Peter Mushangwe is a banking analyst at Moody's. Now, joining me in the studio to preview the MPC's decision are Nnamdi Nwizu, co-managing partner at Comercio Partners. We also have Bismarck Rewane, CEO at Financial Derivatives, and Muda Yusuf, the Director General at the Lagos Chamber of Commerce and Industry. Gentlemen, thank you so much for joining us. I will start with you, Bismarck, and just get your thoughts. Many are calling that we could see a decline in rates today, a rate cut, but others are also suggesting that that would only be symbolic, given all that has happened before this meeting. Overall, what are your expectations?
I think that I would say 60% probability that there will be a cut of 50 basis points, and 40% probability that it will stay unchanged. Why do I say this? Because nominal rates have actually, and effective rates have actually come down. There is system-wide liquidity. There is a clear directive, what I can call more than moral suasion, to compel the banks to deploy assets in terms of loans.
Right. The central bank appears to be, if you like, more aggressive about that now. They have been appealing.
I mean, no, it's not moral persuasion.
I think on this show we even called it perhaps maybe
moral coercion.
No, I think the term we use is patriotic lending.
No, that was patriotic lending, but I call this moral coercion.
Yes.
But
so the tone has clearly changed.
No, the clear has changed that you got to do it, or else you're toast. So I think that the thing is that the framework for monetary policy in Nigeria is inflation targeting. The nominal anchor, or the anchor, is the interest rate. That anchor should take along with it other rates, but the other rates have already moved. So it's the rates actually moving the anchor rather than the anchor moving the rate. That is clear. So I think that's the fundamental objective. Why would they do that? The U.S. is likely to cut rates, maybe 25, who knows. And there is a general tendency of accommodative monetary policy to actually confront the specter of a global recession, which I don't think is going to happen. So having said that, with inflation declining and interest rates in the U.S. coming down, the interest rate inflation differential, which is now in favor of Nigeria. So no better time to do this than now, right? What the impact is another story altogether. Okay.
Nnamdi, I want to get your thoughts again on whether or not you agree that it will simply be a symbolic cut if they do cut today. But also I want you to speak to, to some extent, the points that Bismarck has just raised about what's happening globally and overall how this could impact whatever strategy the MPC has. Because there's always a concern anytime you're cutting rates in Nigeria that we could see a flight of capital away. There could be a lot of pressure on the currency. How do you assess things in the current global context? What a rate cut and moving ahead with this lower rate plan could have on the Nigerian economy and financial system?
Okay, so first of all, I agree that if you do have a cut, it most likely be symbolic. I think to a large extent, the central bank has sort of usurped the powers of the Monetary Policy Committee because they more or less already, with using OMO rates, decide which way they want to move interest rates, whether up or down. So there's a possibility of a cut, just a token, the ability to show this a direction that we're going to. If you're looking at the global economy, you're looking at Nigeria, looking at the fact that a lot of the reserves we have today would be basically what you call hot money, which are people who have been coming in basically doing the carry trade, where they are borrowing dollars at 2-3% and coming to invest in their treasury bills. So the risk we face is that when those rates start to go down, start to tank, you would have people who would refuse to come because the rates are not so attractive. So let's not forget we started with 22% yield about 2-3 years ago. Now you're down to T-bills giving you about 13.5 on the 1 year at the OMO auction. So that's a big drop. And then you also have those who have positions already who would decide, you know what, it's time to take profit and let's get out. The only flip side to it would be that yield would also be going lower in their own country. So the question will now be, so do I want to go back and go back into what maybe like 2%, 10 years or 1.5%, depending on what the court ends up doing or what the Fed ends up doing with regards to cutting rates. But I think, however, that the lower the rates go locally, then the more likely you are to see the foreign investors, the hot money people, start to move their funds back out. Central Bank has to be prepared for that.
Okay, we need to go to Abuja briefly, but Muda, if you can just also give your thoughts on the dynamics in the market. Clearly, lower rates is something that corporate Nigeria would like to hear, but are you concerned about the dynamics that we're seeing and the way the central bank is pursuing this target?
Well, from the real economy point of view, the sensitivity to rate cuts within this context is not that high. You know, there are bigger concerns around issues of regulatory risk, for instance. The rate at which directives are coming as to what sector should come to forex market, what sector should not come to forex market. So
those are your concerns?
Those are issues that, because you don't know what sector is next, and this bring a lot of shock to the economy. So these are much bigger concerns, you know, for me than the issue of rate cut. Of course, the policy intervention in terms of the loan-to-deposit ratio and other related things, I'm sure has very good impact in terms of rates. But the regulatory risk that the CBN poses now, I think is a much bigger issue. Yeah.
But before we go to the governor, I guess anyone on the panel can react to this. How concerned are you that the currency could suffer as the central bank continues to, and the MPC pursues this policy of lower rates? Because in the past, and we also have, if you like, the example of Ghana, where they cut, and maybe some suggest that it's not the same situation.
Definitely not the same, but the currency will suffer. There's no question about it.
So we should expect
we should be able to live with that. If, because you brought down interest rates, there is an impetus to growth in terms of lending to small and medium-scale enterprises, if that is done, then the natural consequence of that is an increase in inflation, a weakness in the currency, but the increase in growth, the range of the increase in growth will probably, compared to 2% which you're getting now, if you can get at 1% more, that's already 66% better than what you had, compared to the increase in rate of inflation, or maybe a 2, 3, 5% decline in the value of the currency, which even makes the naira more competitive.